Hello everyone, as you can see, we're at Embassy Thailand right now. There's a lot of people having chaos and there's a riot going on over here. What? Nature is coming? We gotta go. Home. Hello everyone, welcome back to News Gen Z. Today's segment is about the financial crisis of 1997, a major economic shock that started in Thailand and swiftly expanded throughout East and Southeast Asia. The Asian financial crisis of 1997 caused severe financial and economic instability. After losing its foreign exchange reserve in an effort to maintain its fixed exchange rate, Thailand was forced to float its currency, the baht, which sparked the crisis. Now, that is just a general introduction for it. Let's hear it more from Ms. Ain about the background history.
Of course, in the years leading up to the 1997 Asian financial crisis, countries like Malaysia, Thailand, Indonesia, and South Korea were experiencing strong and steady economic growth. These countries became known as the Asian Tiger or Tiger Cubs. However, beneath the surface, many of these countries were silently building up large debt in US dollars. This created hidden weaknesses in their financial system. When foreign investors started to notice this risk, they began pulling out their money, causing a sudden loss of confidence. The crisis began in Thailand but quickly spread across the region. Investors became worried that other Asian countries might face the same problem, so they withdrew their investment before it was too late. This led to currency crashes, stock market decline, and economic slowdown across Asia. Now, let's move on to my colleague Naim.
So right here, I will talk about the causes of the financial crisis 1997. So the first point is currency speculation and devaluation. So the Thailand's economy relied on the fixed exchange rate system that pegged the baht into the US dollar. This was meant to create currency stability and attract foreign investors. However, over time, Thailand's economy shows signs of the weakness, rising debt, falling export and import, and growing current account deficit. By July 1997, Thailand ran out of reserve and was forced to float the baht, causing its value to plunge. This sharp devaluation triggered panic across Asia. Countries with similar vulnerabilities such as South Korea, Indonesia, and Malaysia experienced speculative attack on their own currency. As their currency fell, the cost repaying foreign loan and increased dramatically. This sparked a regional crisis with collapsing currency, massive capital loss, and severe economic damage. So to add on more points, I will invite Ms. Kur to give your introduction and give your point.
So my name is Nur Krasalia. To add more point, it was what we call capital flight, which means foreign investors pull out their money very quickly. Before the crisis, countries like Thailand, Indonesia, and South Korea were growing fast, and investors were excited about the high return like banking, real estate, and stocks. But when Thailand's currency baht collapsed, it triggered fear. Investors lost confidence and began withdrawing their funds in a large amounts. That sudden outflow of capital created a liquidity crisis. On top of that, local currencies dropped sharply in value, especially against the US dollar, which made it almost impossible for these current countries to repay their foreign debts. In Indonesia, for example, the rupiah lost over 80% of its value. Banks were shut down, inflation rose quickly, and poverty worsened. Meanwhile, in South Korea, some of the biggest companies or chaebols went bankrupt, and the government had to request a $58 billion bailout from the IMF.
So yes, I agree with you, Ms. Kur. Do you have any point to add on?
Yeah, the next one was excessive short-term foreign borrowing. A lot of the money borrowed from US and European banks had to be paid back within a year. That's a very risky, right? Because when the currency value drops, it becomes much more expensive to pay off those loans, especially when they are in US dollars. In fact, in many cases, this country had more short-term debt than they have in foreign currency reserve. That's called a maturity mismatch. So when foreign lenders refuse to renew the loans, these countries simply didn't have enough to pay them. Financial system looked strong on the outside, but they were actually very fragile. There were also warning signs like high current account deficits, budget deficits, and poor debt service ratios, meaning they struggle even to pay interest on their loans. When all of this combined, risky borrowing, falling currency, and loss of investors' confidence, it creates a chain reaction that affected to the whole region.
Another reason was that a lot of people thought their local currency would stay stable. So they borrowed money thinking the exchange rate would not change much, but that was a risky assumption. Also, instead of using those loans to build something long-term, like starting businesses or improving infrastructure, many people used the money to make quick profits, like speculating in real estate or the stock market. Then, when the global interest rate started to rise, pressure mounted. Short-term loans become harder to repay, especially when the cost of borrowing suddenly jumped. And another big problem, many people borrowed money in foreign currencies like dollars, but their income was in their local currency. So, when their currency dropped in value, it became way more expensive to pay back those loans.
So thank you, Miss Kur, for your time for today.
Thank you.
So the last point for today is the lack of transparency and crony capitalism. One of the internal causes is that and the corporate sector. Many banks and companies operate without proper oversight and regulation. Financial statements were often inaccurate or incomplete, hiding the true level of debt and risk from both domestic and also foreign investors. Because of this weak reporting standard, large amount of risky foreign borrowing went undetected. When the crisis hit, the lack of transparency made it impossible to accurately assess damage and causing even more panic. In addition, crony capitalism was widespread in many affected countries. Politically connected firms were granted easy access to government loans and also contracts. Regardless of their business performance, this led to mislocation of resources and poor investment decisions. When the crisis struck, disfavored but weak companies collapse, further undetermined confidence in the economy and worsened the financial crisis.
One major reason the Asian financial crisis worsened was the lack of early warning system to detect financial imbalance. Government and regulators were slow to notice the growing risk, especially the overdependence on short-term foreign loans by many firms. This loan taken without proper safeguard become unmanageable when crises developed. At the same time, political interference weakened the independence of financial institutions, making it harder for them to take action based on economy needs. There was also a serious lack of investor protection and weak legal enforcement, which reduced trust in the system and discouraged long-term investment. Altogether, this weakness made the region highly vulnerable when the crisis hit.
So back to my colleague in the studio, Nisa, with our guests.
So guys, we are now with Miss Amira, Miss Anis and Mr. Amirul to talk more about the financial crisis of 1997. Miss Amira, can you share with us what's your point is about the effect of this crisis?
Thank you, Nisa. So let's start with the political effect of the 1997 Asian financial crisis. In Indonesia, the economic collapse led to protests, riots, and the eventual resignation of President Suharto, ending over 30 years of this rule. This was the beginning of a major political reform movement called Reformasi. It wasn't just about the economy, also the people wanted justice, democracy, and real change. In Malaysia, the government took a different approach by rejecting IMF aid and imposing capital control. But this led to political tension, especially after Deputy Prime Minister Anwar Ibrahim was removed. The public response was strong, and the reformasi movement also started here, calling for political transparency and accountability. Now, we're moving on to global business practices. The crisis made international investors much more careful when entering developing markets. Companies started to prioritize long-term sustainability over quick expansion. In countries like South Korea, big companies were forced to reform, reduce their debt, and become more transparent. The crisis also pushed Asian countries to work together. One example is the Chiang Mai Initiative, which helped countries support each other during future financial trouble. The crisis didn't just change investor behavior, it forced real reform. Countries that received international financial aid had to improve their corporate governance, apply international accounting standards, and increase transparency. In South Korea, large business conglomerates called chaebols were required to restructure. They had to reduce their debt and focus only on their core activity. This marked a shift towards stronger risk management and better oversight. At the same time, regional cooperation improved. The Chiang Mai Initiative, for example, became a way for Asian countries to support each other in future financial crises without relying only on Western institutions like the IMF. Overall, the 1997 crisis was a turning point. It made companies rethink their priorities. Instead of chasing fast profit, they focus on long-term sustainability and stronger financial system.
Okay, now, Mr. Amirul, can you tell us more about your points on the effect?
Today, we look back at the 1997 Asian financial crisis, a major event that shook the region's economy. One of the biggest impact is massive currency depreciation. Countries like Thailand and Indonesia saw their currency lost over 50% of their value against the US dollar in a very short time. This happened due to a loss of investor confidence and aggressive speculative attack. The results, countries and businesses that borrow in US dollars struggled to repay their debts, bankruptcy cases spiked, prices of imported goods skyrocket, inflation hit hard, and the people suffer as purchasing power dropped and unemployment rose. The second effect is foreign intervention and reforms. The chaos didn't last forever. With help from the IMF, affected countries began tough economic reforms. Bailouts were given, but came with strict conditions like public spending cuts, high interest rate, and bank restructuring. Nations also switched to more flexible exchange rate system and improved financial transparency. These changes help restore investor confidence and prevent future crises. But let's take a step back and imagine, what did all this really feel like for the people living through it? Imagine waking up one day and suddenly your savings are worth half of what they used to be. Prices in shops double overnight. A bag of rice, cooking oil, school supplies for your kids all become almost unaffordable. Business owners, especially small ones, were hit hard. Many had taken loans in US dollar thinking they were stable, but when their local currency crashed, repaying those loans became impossible. Factories shut down, employees were laid off. In Indonesia, the crisis led to massive protests and even political upheaval. For governments, it was a wake-up call. They had to face tough decisions, accept the IMF conditions, or risk total collapse. While the bailout saved the economies, it also meant painful reforms. Interest shot up and many felt the burden of the recovery. But in the long run, it taught the region valuable lessons. Countries started building stronger financial systems, transparency improved, they became more cautious about borrowing and kept higher foreign reserve. 1997 crisis wasn't just about money, it was about people, survival, and learning the hard way how fragile an economy can be. And that's why understanding these effects is so important today.
Moving on to Miss Anis, here to share some important lessons we can learn from the 1997 Asian financial crisis. Welcome.
Hi, thank you for having me.
Let's get into it. What are some lessons we can learn from this crisis?
So firstly, we should avoid short-term foreign debt. Before the crisis, countries like Thailand, Indonesia, South Korea borrowed a lot of money from foreign banks. By the end of 1996, Short-term debts in Korea and Indonesia reached $68 billion and $34 billion. These countries took loan because the interest rates were low. Many companies went bankrupt because they couldn't afford to pay this. So this made investors panic and pull out their money, which made things worse. And secondly, countries need to have strong financial system and reforms. One reason the crisis happened was because banks in this country are weak and not well managed. After the crisis, countries like South Korea and Thailand improved their bank rules and made their financial system stronger. However, Malaysia, our country, did something different. Instead of taking help from IMF, Malaysia made its own policy. The government fixed the ringgit to 3.80 cents against the US dollar and introduced capital controls to stop money from leaving the country. They also create Dana Harta to manage bad loans and Dana Modal to support weak banks. Malaysia even formed the Corporate Debt Restructuring Committee, CDRC, to help big companies restructure their debts. Because of this step, Malaysia recovered from the crisis by late 1999. Thirdly and lastly, we learned that it's important to have diverse and balanced economic growth. Before the crisis, many countries depended too much on export and foreign money. When that stopped, the whole economy crashed. There was also too much focus on property and finance, which create a bubbles. After the crisis, government started focusing on local demand, education, and better social support. The World Bank also said that for long-term growth, countries need to focus on people's well-being, not just fast profits.
That was really clear and informative. Thank you, you guys, for sharing.
And that's wrapped our coverage of the Asian financial crisis. Though it happened over 25 years ago, the effects were deeply felt and served as a reminder of how quickly things can change in the world of finance. It challenged leaders, test economists, and taught valuable lessons that continue to shape policies today. Thank you for joining us. Until next time.